Finance Minister of Luxembourg, the present and former chairpersons of IFSCA, ladies and gentlemen, it's my great pleasure to deliver the keynote address at the Global Securities Market Conclave 2.0 organized by GIFT IFSC. We meet at a time when global capital markets are being reshaped, not by a single shock, but by the simultaneous forces of geopolitics and technological acceleration. The question before us is simple to articulate, but complex to resolve. How do we reliably and intelligently channel the global capital at scale into productive opportunities? Financial globalization today differs markedly from earlier decades. Capital flows increasingly through networks defined by trust, institutional credibility, regulatory reliability, and data infrastructure. Investors have become more discerning, preferring jurisdictions that combine macroeconomic stability with geopolitical alignment and technological readiness. At the same time, capital markets have become more sensitive to high-frequency information signal. The IMF's Global Financial Stability Report of October 2025 highlights a rising tendency towards herding behavior, or as global investors rely on similar AI models and respond rapidly to micro-information transmitted through digital and social platforms. These developments raise the possibility that financial cycles may become both longer and more amplified. Alongside geopolitical shifts, advances in artificial intelligence are transforming how capital is priced and allocated. AI lowers the cost of prediction, accelerates information processing, and enables investment decisions to be executed at unprecedented speed and scale. Portfolio allocation, risk assessment, and liquidity management are increasingly influenced by algorithmic systems capable of learning continuously from vast data sets. As informational barriers decline, opportunities expand for economies able to demonstrate transparency, institutional credibility, and technological capability. Technological transformation, however, also introduces new policy responsibilities. Algorithmic trading and AI-driven investment strategies can transmit shocks rapidly across jurisdictions and amplify market movements. Supervisory frameworks, therefore, must evolve to detect model-based herd behavior, operational vulnerabilities, concentration risks in critical AI supply chains, and systemic feedback loops. Financial stability in the coming decade may depend significantly on regulators' ability to understand and supervise risks embedded in digital and AI-enabled finance. India's growing prominence in global finance must be viewed against the backdrop of cumulative structural transformation. Progress in India has been institutional rather than episodic. Macroeconomic stability has strengthened investor confidence. Sustained reforms have improved governance and transparency. Digital public infrastructure has sharply reduced transaction cost, and domestic capital markets have deepened through broader participation and improved market architecture. The response of global investors provides empirical validation of these structural improvements. Cross-border financial flows, including portfolio flows in equities and bonds, as well as foreign direct investment, remain central to India's integration with global capital markets. India has consistently attracted sizable gross investment inflows amounting to 18.5% of GDP in FY25 and 16.9% in the first half of FY26, even amidst tightening global financial conditions. According to UNCTAD data, while India recorded a marginal decline of 2% in FDI inflows in calendar year 2024, it still remained the largest recipient of gross inflows in South Asia and surpassed major Asian peers such as Indonesia and Vietnam. The moderation in inflows was modest when viewed against sharper contractions experienced by several other large emerging markets. Greenfield investment activity offers further insight into evolving investor sentiment towards India. India ranked fourth globally in calendar year 2024 with 1,080 announced greenfield projects and emerged as the largest destination for greenfield digital investments between 2020 and 2024, attracting US $114 billion, well ahead of Malaysia, Singapore, Vietnam, Mexico, and China. Investment has increasingly concentrated in digital services, data centers, and information technology infrastructure, reflecting a growing alignment between global capital and India's digital growth trajectory. These developments suggest that India's integration with global capital markets is deepening not only in scale, but also in composition and quality. India's digital public infrastructure represents a foundational milestone. The integration of identity systems, payment architecture, and data frameworks has reshaped financial intermediation by expanding access while improving efficiency and transparency. It demonstrates that technology, when deployed as a public good, can underpin sustainable and inclusive financial globalization. The natural progression from strengthening macroeconomic domestic fundamentals is the creation of institutional platforms that enable deeper engagement with global capital markets. GIFT IFSC exemplifies this progression. By providing an internationally compatible financial ecosystem within Indian jurisdiction, GIFT IFSC facilitates cross-border investment, innovation, and experimentation in financial products while remaining anchored in India's broader regulatory framework. Prior to GIFT City establishment, many Indian companies raised funds or managed offshore investments through jurisdictions such as Singapore, Mauritius, and the Cayman Islands, largely due to more favorable tax and regulatory frameworks. The IFSC architecture seeks to repatriate financial services transactions currently conducted outside India by overseas financial institutions and overseas branches of Indian financial institutions as well. In doing so, it aims to attract multinational banks, investment funds, and technology firms, generate high-value employment, draw in global capital, and reduce financial outflows to offshore centers. Recent developments, including growing institutional participation, improved global rankings of GIFT City, and expanding market turnover, indicate early but tangible progress in strengthening India's position within global financial services value chain. As cross-border finance expands through technology-enabled platforms, managing capital mobility responsibly becomes essential. Greater efficiency in capital markets must be matched by resilience against volatility. India's approach, therefore, has emphasized calibrated integration, encouraging openness where institutional capacity and market depth justify it, while maintaining safeguards that preserve macroeconomic stability and policy autonomy. Sustainable financial integration ultimately rests on proper sequencing, prudence, and institutional credibility. At this juncture, it is appropriate to reflect on a broader structural question. Trade fragmentation is now widely recognized as economically inefficient because it distorts resource allocation and constrains specialization. Capital market fragmentation, in contrast, presents a more nuanced set of trade-offs. In frictionless theoretical models, full integration of capital markets enhances welfare by enabling global risk sharing and lowering the cost of capital. In the International Capital Asset Pricing Framework developed by Robert Merton and extended by Bruno Solnick, investors hold the market portfolio, global market portfolio, country-specific risks are diversified away, and capital flows towards its highest risk-adjusted return. However, that benchmark rests on assumptions that do not always hold in practice. Financial integration can synchronize behavior. Portfolios become similar. Risk models converge and correlations rise, particularly during periods of stress. Interconnectedness enhances risk sharing in stable conditions but can amplify contagion in adverse states. Recent analysis by the International Monetary Fund demonstrates that even traditional diversification between equities and bonds has become less reliable during market sell-offs, as correlations between these two asset classes have risen and protective properties have weakened. When both stocks and bonds decline simultaneously, losses compound rather than offset. This weakening of diversification benefits illustrates how evolving correlation structures in highly integrated systems can erode the foundational assumptions of portfolio construction. Some degree of segmentation arising from regulatory frameworks, currency denomination, differentiated investor bases, or macroprudential design can actually preserve heterogeneity and moderate systemic spillovers. It can create policy space and reduce exposure to volatile global financial cycles. At the same time, persistent segmentation entails costs. Higher cost of capital, reduced liquidity, entrenched home bias, and potential misallocation of savings. The policy challenge, therefore, is architectural rather than ideological. It concerns achieving an appropriate balance between openness and resilience, between global risk sharing and domestic policy autonomy, between allocative efficiency and systemic stability. In an era where AI-driven trading systems can synchronize behavior across jurisdictions within milliseconds, maintaining this balance becomes even more complex. This analytical question is directly relevant to the present phase of artificial intelligence itself. Ownership concentration, related party transactions and valuation transparency within segments of AI ecosystem, related party transactions and valuation transparency within segments of AI ecosystem have also come under increasing scrutiny. Financial round-tripping and leverage embedded in private funding structures add further opacity. In such circumstances, highly integrated capital markets may amplify exuberance alongside innovation. When benchmark indices, passive flows, and algorithmic strategies converge on similar AI-heavy exposures, price discovery risks becoming momentum-driven rather than fundamentals-driven. For India, strategic patience may therefore represent a strength rather than a limitation. It is not necessary to be the first mover in every technological wave to be a long-term beneficiary. A second mover advantage permits careful observation of technological maturation, regulatory adaptation, and business model consolidation before large-scale capital deployment. It enables selective integration participation in AI-enabled productivity gains while avoiding disproportionate exposure to valuation cycles or infrastructure overextension. India's comparative advantage extend beyond frontier model development. They include scalable digital public infrastructure, cost-efficient engineering capabilities, a large and dynamic domestic market, and the capacity to deploy technology across sectors in ways that enhance productivity. Embedding AI within this broad development framework may yield more durable gains than positioning the Indian economy as a speculative proxy for global AI exuberance. Thus, the debate between integration and segmentation is neither abstract nor academic. It shapes how we approach capital flows in the age of artificial intelligence. A resilient financial architecture does not pursue every cycle indiscriminately. It differentiates between durable innovation and financial excess. Calibrated integration combined with institutional credibility and prudent sequencing may better serve long-term stability than either unqualified openness or rigid insulation. Reducing frictions in cross-border payments constitutes an important avenue for improving global capital allocation. Faster settlement systems, interoperable payment platforms, and transparent regulatory standards reduce transaction cost and broaden participation in international finance. In the December 2025 BIS Bulletin, Thomas Lammer and co-authors note that improvements in payment infrastructure can reshape cross-border financial activity by reducing operational barriers and increasing the importance of coordinated supervision. India's ongoing efforts towards payment interoperability and digital financial connectivity align very closely with this evolving global agenda. Technology alone cannot build vibrant financial markets. Financial ecosystem flourishes when regulators, market participants, and innovators perform complementary roles. Policymakers can provide stability and predictability, but liquidity, innovation, and market depth ultimately depend on investors, intermediaries, and institutions. Long-term capital, responsible innovation, and constructive engagement with regulatory frameworks remain central to the continued development of India's capital markets. Therefore, to the investors, asset managers, and financial entrepreneurs present here, my requests are as follows. Please bring capital with patience and constructive engagement. Long-term demonstrable commitments to India's productive economy reduce the cost of capital for everyone and enhances returns. Invest in transparency. Treat governance and disclosure as reputational assets that reduce borrowing costs. Be partners with regulators on sandboxes and subtech pilots that build resilience rather than evade scrutiny. Innovate responsibly. Complexity without clarity destroys securitization everywhere. Build liquidity as a shared responsibility. Liquid markets require trading. Buy and hold alone cannot create depth. To the banking and fintech community, use India's DPI responsibility to lower transaction costs and expand access. Invest in robust model governance and operational resilience for AI systems. Maintain governance and disclosure as core pillars. Support innovation with transparency and not innovation without accountability. Simplify issuance processes. As discussed in the Economic Survey 2026, India's strong macroeconomic performance coexists with a global environment that does not automatically reward economic strength with stable capital flows, underscoring the importance of strategic engagement with the evolving global financial system. India's aspiration to become a developed economy by 2047 will require sustained mobilization of both domestic and global capital. The objective is not merely to attract financial flows, but to channel them towards productive investments that enhances productivity, strengthens infrastructure, fosters innovation, and generates employment. A financial system that combines technological sophistication with institutional prudence can act as a stabilizing force in an increasingly uncertain global environment. India's journey reflects an effort to contribute constructively to an evolving global financial order. The task before policymakers and market participants alike is therefore not merely to respond change, but to shape it responsibly. With these reflections, I wish the Global Securities Market Conclave 2.0 every success and look forward to discussions ahead. Thank you very much.
If you like the video, do like, comment, share and subscribe.